Hi folks, can you believe it? It's Tuesday again. Seems to come around every week. How are we doing? Nice to see you all on. I'm going to put the pre-show on just for a moment as we come up towards 8 o'clock. Nice to see the chat going well, and hope everybody is well this evening. I hope you didn't get too cold with the snow and everything else that we had across some parts of the country. And it was amazing that the Bureau of Meteorology, I think, forecast a very warm winter, and well, maybe not. Going to have a very interesting conversation this evening, of course, as always. The doggies are here, as you would perhaps expect. Yeah, well, one doggy, the other doggy keeps jumping out of the basket, but they are around. And of course, the studio is here. Damien's teed up, ready to come in over there. So we'll bring him in just a moment when we go into the main show. We're going to have a very interesting conversation this evening. There's so much to talk about with regard to the markets. And some interesting questions that I'm sure will kick around this evening. So I'm looking forward to that. Anyway, we've just hit over the 8 o'clock mark, so I'm going to take the pre-show off. I'm going to start the show properly. I'll be back in just a moment. Well, good evening. Welcome to this live stream on the 5th of August, 2025. I can't believe that we're in August already. It's Martin North here from Digital Finance Analytics. Great to have you on this evening, and thank you very much for taking some time out on a Tuesday to spend it with us. Really appreciate it. We're going to have an interesting conversation about the markets this evening. Damien is, of course, very much teed up and ready to come in with slides, etc., etc. And, we're going to kick around things like, will markets go higher or not? There is a poll, and if you've not voted, you can vote there as to whether you think markets will be higher or lower by the end of the year, or whether you think they'll go sideways, or whether it's impossible to say. So be interested to get your views there. We'll bring that poll in later in the show. And, of course, with tariffs and AI and all of those things, interesting conversations there. I'm going to talk also with Damien about the volatility and how volatility plays into investing strategies, and a lot of other questions too. And of course, as always, if you've got questions, throw them in. Just to remind you before I bring Damien in, we're not providing specific financial or legal advice. This is a general conversation only. We moderate the chat, but feel free to throw your questions and comments in there. And if you use that Walk the World, that'll get it into my queue so that I can see your questions and bring them into the conversation. I've also enabled Super Chat, which means that you can get your question to the top of the list, or indeed make a contribution to what we do around here. Really appreciate all those who help us with funding what we do. We don't do this for profit. We do this because there's a very important conversation to be had, and we couldn't do it without your help. So thank you very much for all those who contribute via Super Chat, or indeed support us via Patreon or via the other mechanisms in the chat below. Anyway, let's bring Damien straight in, and we'll get going. Damien, welcome back. How are you going?
Not too bad, Martin. I was commenting here before. It's flown around this month. It has, we've zoomed.
So quiet. I mean, there's nothing to talk about, really. I mean, it's, you could almost turn off the markets and come back in November, right?
Yeah, that's right. And in your poll, do you have an answer of both? It will be both higher and lower before the end of the year.
Yeah, well, yeah. There was only unfortunately I could get 4 in there, so it's a matter of trying to figure it out. But yes. As we sort of get into this, Damien, let me just sort of seed a couple of initial thoughts, because of course, if you look at the markets, this is the S&P 500. We had a bit of a, that's the equal weight. Let me just go to the other one. Let's go there. We had a bit of a run up, and then we had a bit of a run back, and then we had a run up again. So what is going on with the markets is an interesting question. And if you look at over the last little while, Friday was a down day because, of course, there were a lot of issues there.
Yeah.
And then we had an up day on Monday. When you actually look at it, there are other little interesting observations here. So, for example, this is actually from the AFR a little while ago, saying markets are at risk of a reversal. The next month is crucial. Will it go up or will it go down? And they're basically trying to offset the questions of tariffs with questions of AI and whether the AI boom will continue to support markets higher, or well, in fact, will the issues around tariffs, or indeed broader issues. And just to be clear, tariffs, around 17% now estimated, according to Capital Economics, up from 2 point something previously. Although, of course, revenue in the US was, from tariffs is growing quite high. So it's really interesting to try and figure out, where do we go from here? And that's really what I want to explore today. And from an investment perspective, because obviously we're looking for, long-term sustainable goals for an investment strategy. How do you try and balance these two potential futures? One where effectively the tariff thing bubbles on and on and on, and we've already seen tariffs for India being upped again as Trump moves the lever from reciprocal tariffs through to stuff that's more about, you were doing trade with Russia, so we're going to up your tariffs. So you can see this tariff lever being pulled always. And yet, on the other hand, you've also got the AI story and the big boom of many AIs recently. So, how do you make sense of it all, Damien?
Yeah, it's tough. I feel like I feel like I could on that one question alone, we could go on for the next hour. Let me try and cut it back to, I guess, a few of the a few sort of pertinent points, and then maybe we can jump in and deal with them in a bit more detail.
Sure.
So, from an earnings perspective, the earnings looks pretty good. And there's this part. I might get a couple of charts I can show on the earnings. Let me see if I can bring some up for you. I've got one here just sort of showing the number of companies that upgraded their earnings. We're sort of seeing, net income higher than the last year. And so it's sort of middle of the range. It's certainly, this sort of goes through big cycles, as you can see, throughout time, but it's certainly nothing, it's certainly way better than it was just a couple of years ago in terms of what we're seeing. There's another one, which is just one of the key things I keep coming back to. I've got this chart up, which is, it's a little bit hard to read, but it's worth understanding. Is the blue line is the 12-month forward numbers over time. So that's the one that it's basically taking a little bit more of 2026 and a little bit less of 2025 every day that goes past, and so you get this gradual rise. And then the individual lines on that graph are the individual lines for each year. And so you can see at the moment we've got this 2025 right at the end. This 2025 number has come down quite a lot over the last year, but that blue line just keeps going up. And that's the key part, is that even though you've got downgrades to earnings, if the growth forecast is still pretty good, then it doesn't really sort of matter in terms of the underpinnings of the market. And what I mean by that is, if you're expecting, say, 12% growth, which is what I think we were expecting about a year ago for 2025, now it's 8% growth. Look, 8% growth is pretty good. You're getting an 8% growth. You're getting a dividend yield on top of that. That's not a bad return for the market that you'd sort of that you sort of get back from. And then just coming back to that 8% at the moment, where's that coming from? A lot of that is coming from those sort of the Magnificent Seven, those top 6 or 7 stocks gives you, 2.5 of that. So a third of that growth is coming from just a handful of stocks. And I think actually if you pull Tesla out of that, it looks even better again. And then you've got the rest of the US, which is where we've seen the most amount of downgrades. And then the rest of the world, it all looks pretty decent. And so there's this idea that, really what we're focused on is, are we going to start seeing a hit to earnings? And within that, I've spoken a few times about when I've come on here, there's this disconnect as well between large companies and small companies, where large companies have got a much better at avoiding the tariffs. They've got a lot of factories in a lot of different areas, and also they're making big orders. And so they can flip things around and go, right, oh, really? All of a sudden, India's got a higher tariff going into the US. Okay, maybe we'll use some more of our Bangladesh production or more of our Indonesian production or whatever it is to ship through there, and we'll send the Indian stuff somewhere into Europe. Or you've just got that bit about moving around, where small companies tend to have 1 or 2 suppliers and they just can't do it. And so maybe what we're seeing, and it certainly seems to be coming through in some of the earnings figures we're seeing, is that margins are sort of holding up not too bad. And so maybe it's this. Some of it's like, yes, it's not good overall, but actually it's a lot better for large companies than what it is for small companies. So that's one part of it. Then the second part, as you said, is this AI. So the tech part of the industry, tech part of the index, is sort of 40% of the S&P 500, probably more actually. I think you probably, depending upon how you wanted to cut certain companies and how they fit, you could probably get it up to 50 or 60%. And that's, first of all, seeing some real growth from AI, and secondly, there's quite good productivity gains that we're seeing throughout the US. So you're sort of faced with this two part about saying, okay, so if the real economy is not doing as well because a lot of it's made up of small companies, and there's a reasonable amount of consumption and other things that are struggling, but you've got mainly large companies and mainly tech focused, and that area is doing fine, then maybe you can see some justification why markets might hold up a bit better than what you might have thought. And so, so that's sort of one part that I keep coming back to. I was going to talk about something else as well.
Just before you go on to that, let me just bring this slide in because I think it's quite relevant. So this is actually the tech versus the S&P 500, right? And this is actually from Bank of America. And you can see there that tech is, well, relatively higher than the rest of, even back in the year 2000, right, which was the dot-com bubble. And here's another little story. If you look at the top three holdings, 20.8% of the S&P 500 is now NVIDIA, Microsoft, and Apple. So there is actually an incredible concentration there amongst a few stocks. And I suppose if you believe that they're going to actually continue to outperform and do well, then that's going to support the index. And another way of looking at it, the S&P 500's top 10 biggest companies are pulling away from the rest of the pack, which is your point again, isn't it? So, you've almost got to have a view that says the S&P 500 isn't one market, it's actually multiple markets, right? And you've actually got to come down and look at the different components to try and figure out. And if you think about where the tariffs are going to be hitting, well, to an extent, the tariffs are going to be hitting in areas that maybe the big AI firms can sort of miss.
Yeah, absolutely. And one other one I wanted to add in, there's a few different ones I want to do. One of these, so I don't forget as well. One of the ones, so the other thing is that large companies disproportionately have more international operations.
Yeah.
And so, you're looking at a US company that might be struggling because of tariffs or whatever it is. But when you look at some of the, if you look at the average sort of large cap stock that might have 40 or 50% of its earnings coming from offshore, the US dollar's been falling. Those earnings are actually heading up, with that basis. Sorry, excuse me. So is that? Oh, then the concentration side of it. Yeah. So I was going to make the observation that with concentration risks like that, it's starting to look a lot more like Australia than somewhere else. Australia's got.
Yes. I mean, absolutely. They've
got concerns about concentration, and I get it. Like there's, I think it's the top 10 are sort of closing in on 40% of the index. I'm actually doing a podcast on that later on this week. But the Australia's been like that for ages. We've got Commonwealth Bank alone is sort of 12% of the market, and you add in, the next couple of, the banks on them, the four big banks probably give you the similar type of exposure in Australia, and that's So there is that part of the whole, where it's not a matter of saying you can look at markets and say there is definitely problems within markets, and there's certain sectors you need to avoid, and you can look at negative effects, but knowing the makeup of the market and which of the sectors, if the big sectors are going to do well, then that's and that's going to carry the market higher regardless of what's happening in some of the small sectors.
Yeah, absolutely. Now let's just sort of take the conversations just slightly further, because of course the other side of the equation here, as well as the tariffs, was the Trump response to the big shift in the employment data that came out.
Yeah. Oh, actually, sorry, before we get to that one, can I just click on that? It's worth showing that chart I've got up at the moment as well.
Okay. Yeah, go on.
Get to that.
Yeah.
What I'm showing here is the annual returns for trend following hedge funds. Now, a lot of this data is it's hard to tell who's what, but effectively what this is your momentum traders. So these are people who, it's whether you're using charts or whether you're using sort of quant metrics, but it's basically when markets are going up, you keep buying, and when markets start falling, you start selling. And they've had the worst start to 2025 in whatever it is, 30 years, 40 years, or whatever it is, something like that. Probably ever, given the there's not a strategy that's been around for that long. So you can see that there's it's been a pretty successful strategy over time, but really not looking good in the market. And part of the reason why is because we've got Trump flip-flopping everything around and changing and things like we saw yesterday versus today. Yesterday's all the talk about this is the worst day in X number of months or weeks or whatever it was, and then today it's the best day in X number of months or weeks or whatever it is. And so, that flip flopping of Trump in terms of the sentiment and just the fact these aren't foreseeable events when he suddenly decides that one day he's going to wake up and decide to fire the head of his one department or try and put somebody else in jail or whatever it is that if you've got that type of volatility, you really need to sort of try and come back to something that you can sort of hang your hat on a little bit more. And that's where we're sort of saying, well, look, you want to be carrying a bit of extra cash in this type of environment, and you really want to be trying to really get down to those high quality companies. Anyway, I'm sure we'll come back to this at some point, but
no, it's interesting. Well, just on that, I noticed that some, the likes of Berkshire Hathaway and a few others have actually gone heavy into cash. So because of the fact that with the markets pretty fully valued at the moment and the level of uncertainty rising, then what they're saying is, well, maybe safety is the best strategy for the moment until we actually see how things are going to actually, come through. But the issue is, of course, that these tariffs and the Trump story around tariffs is not just a few months. This is going to take a long time to play out, right? Because remember that the average delivery time frame from China to the US is 92 days or something, which means that you're not going to actually see the full impact of whatever tariffs end up being negotiated for 90 odd days. So that's February, March, and they're still negotiating, right? And then, of course, the other point is that Trump does move the dial backwards and forwards. So he's using tariffs, as I said earlier, to impose political outcomes. You could look around the place and see different examples of that, India being one of them. And if he particularly goes on the rampage with regard to Russia and trying to actually turn the dial up there with regard to restrictions on Russia, he's going to use tariffs as part of that directly and indirectly. So my point is, anybody who thinks that this is going to settle down nicely over the next 3 months and then we're going to know precisely where we are, I think are fooling themselves, right? I think this is going to be a continued problem, and that puts, of course, Powell into a difficult situation, right? As he said, we don't know quite where it's going to end up. So the chances are he still won't know in 3 to 6 months' time where it's going to end up.
If he's still there.
If he's still there, exactly.
One more added bit of Well, and I do think there's something on this whole. There's Trump. Trump obviously likes tariffs. Now, I'm not going to let's not try and debate the pros and cons of that just yet, but I do think there's this whole thing with a lot of markets, this idea of the Minsky moment, which is if you've got a steady state in a market, then eventually people just leverage up and leverage up and leverage up to make things more volatile until eventually something blows up. And I do think there's a sort of a similar type of analogy you can bring back to Trump. Well, first of all, investors following Trump with the idea that he's always going to back out, the whole taco trade, he'll always back out, is, well, yeah, he might until one day he doesn't. And then you've got all these people who are like fully invested in that, and that actually causes much bigger problem.
Just on that, did you hear that the person who invented taco, Trump always chickens out, has now come up with wacko, which is that the world always chickens out. In other words, maybe Trump is actually going to hold his position more than he thinks. And maybe, and he quoted the euro area, for example, who basically capitulated to a 15% tariff. So maybe it's wacko rather than taco. I don't know.
Yeah, and is that a reference of? Like, is Wacko's in crazy, or is it a reference to
the world,
Waco in Texas getting
yes,
the troops coming in and killing everyone?
Well, that's an interesting thought, but it was the idea that the world always chickens out. So
right.
but the point either way is this ain't going to get settled anytime soon.
No.
Right? This tariff thing is going to go on and on and on because it is a fundamental principle on which Trump is actually building almost everything. So he's talking about trading down income tax for the tariffs. There were some statements over the weekend on that.
Yeah, and that's where I wanted to lead with this next part, with this same type of Minsky idea, is that Trump put all these tariffs on and everyone said this is going to be terrible. It's going to crash the economy. Now, I don't want to try and psychoanalyze Trump too much because I do think that's a dangerous path to try and do on. But I'm pretty sure he's sitting going, you know what? Everyone told me this was going to work. Wasn't going to work. It's going to crash the economy. It didn't crash the economy. You know what? I can put bigger tariffs on. Because I think that's effectively where he came to from last time. It didn't cause inflation last time, won't cause it this time. Everyone's got it wrong. I'm right. And so the problem is, does he keep just adding more and more tariffs to things until he does break something? Is that is it where if you said, if it had to come out and gone, you know what, it's a 10% tariff on an average 10% tariff on everyone, and some countries get 2 or 3 and other ones get 20, and that's what it is, and we push it out and we see how it goes, and we measure and we look, and a few years later we'll decide, yes, we can do it higher or whatever. Whereas he's sort of like, it didn't cause anything this month. Maybe I should be fine to keep going. And I do think that's a genuine risk to the economy. Is that, as you said, Brazil's got a trade deficit with the US, and there's a 50% tariff because he wants Bolsonaro released. And so, it seems to be, it's going to be, could be easily be just he's going to keep using it until he breaks something with it. Yeah.
And just something else to sort of bring in here, and this is, of course, the central bank in the US, Powell is in a slightly precarious position. We all saw, of course, Trump visiting the central bank and inspecting the renovations.
Yeah, that's right.
And suggesting that it looks a bigger bill, and Powell saying, "Oh, it's not really because there's other stuff in there." But the point is that we are seeing a contention now between the central bank and what they're doing with monetary policy, but the Treasury is also issuing a lot of new bills, so short term, and buying back longer term to increase the money supply. So whilst Trump is increasing the money supply and also doing tariffs, which is actually stoking the economy, Powell is turning the dial back and reducing the size of the central bank's balance sheet, which gets me to a question as to, so how relevant is now the central bank in all of this, or is effectively more and more power accreting around the White House, and through Treasury, are they influencing the economy more than traditionally they have?
Yeah, I must admit, I'm not 100. I haven't looked at this in the last month or so, but the last stuff I'd seen was that, look, Biden and in particular, Janet Yellen was very active in this area as well. And so I'm not sure they've been more active than Yellen was. I might stand corrected over the last month or so.
The latest Treasury activity included the buyback of longer term bonds and the issuing of a significantly higher proportion of short-term bills.
Shorter-term bonds.
And the reason for that is
I think that
the price is cheaper, of course. The price is cheaper when you come in close at
the short end. Yeah, that's right. And I think that was the issue with one of the things is they can't do it as much as they wanted to do it because Janet Yellen had already done that a lot. And so, there's definitely that issue.
Headroom question.
That's sort of, that's looking over there. And the other one is, I can't remember the person's name who resigned, I think today or yesterday. And so there's going to be a new appointment that
Adriana, the Fed you're talking about. Yes. Yeah.
Yes, at the Fed.
Yeah.
So Trump will get to appoint somebody, and there's a reasonable chance that this is somebody who he's going to be, who stands a good chance of being the next one in charge. And so he's basically going to give a platform to somebody who's going to then be able to say, whatever. There'll be 2 Fed chairs, if you know what I mean. There's a Fed chair, and then this is the just a Fed board member at the moment, but the Fed chair in waiting, so to speak. And so the question is, and the problem I guess for him is, does that send interest rates higher than they might have otherwise been at the long end? Because everyone's looking at the Fed chair going, I got to Trump's. I've been put in here. I mean, Trump's going to pick somebody who's going to want to cut rates.
Yes.
And so where the market's going to look at that and say, actually, yeah, they're saying some crazy things. And so therefore we actually need to start putting interest rates up at the long end because we're worried we're going to end up in a Turkey situation where they come in, cut the short-term rates and inflation gets out of control.
And just on that, it's worth noting that the 10-year in the US has dropped significantly, right? So it was hovering around the 4.5. Now it's at 4.25. And in fact, you can look across the curve, and even the 30-year is also down as well. So it is quite significant that the yields do seem to be coming back. In fact, the 2-year is significantly down. And is that then an expectation of future rate cuts? Although the markets are still saying maybe, maybe not, and some people are still thinking that Trump might not get Powell to cut rates, as you say, unless he can find some mechanism to be able to influence. But fascinating also that 2 members of the board actually basically dissented, and of course everybody put that in as job applications to replace Powell down the road.
Yeah, absolutely. So that was. I've got a couple of charts on the jobs because it's a really interesting market in the US market compared to elsewhere. So they obviously came in quite weak, and certainly it's this long trend of the labour market weakening. But over sort of seeing or sort of overlaying this is that the US has a really large informal work sector relative to the rest of the world. So a lot of people do come across the border and they get work, and then when work dries up, they might go back to their own country, who just don't show up in their statistics because just because they're not there, and because people aren't going to, when I'm putting my official job stats in there, I'm not going to tell that I hired a bunch of illegal workers, and so there's this idea. Well, there's over the top of these statistics in terms of the uncertainty. Not only do we have fewer people answering these surveys, but we've also got this problem that, let's just say I'm a restaurateur and I've got 20 staff and 5 of them are undocumented. So I tell the employment office that I've only got 15 staff, whereas I really have 20. Now Trump's in kicking a bunch of people out, and there's a lot fewer immigrants coming in. So maybe I've reduced my staff back to 18 because I've actually got rid of, or maybe actually, let me put it another way. Let's say I lose three of these illegal workers, and so I'm back to 17, and then I want to add another worker, but I can't find an undocumented person, so I have to actually go out and hire somebody. From the labour statistics point of view, I've just gone from 15 employees to 16. I'm actually expanding my workforce, but from an actual workforce, I've gone from 20 back to 18. And so, is that the type of thing that might be flowing through into statistics at this point in the cycle? And the answer is, yeah. Look, definitely you can see it anecdotally, but is it something that's large enough to make a difference? So is even though we're seeing quite weak unemployment or quite weak labour market, is it actually even overstated? Based on where it is. And then the other chart I just wanted to show was that I think you've got a similar one, haven't you? It's just showing that this is the number of people answering the survey, the BLS current population survey. And so back in the 90s and 2000s, it was in the 90 to 95% range. And then basically since 2010, it's been drifting downwards. And then the pandemic really sort of put a real dent in it. And we're back to sort of 65% of people answering the survey. So so we've got a lot less certainty over what's going on, as well as that other issue about the undocumented workers sort of sitting there behind there as well.
Yeah, absolutely. In fact, I've got this chart, which is a somewhat similar one, but this is from Lisa. He said the response rate to the monthly non-farm payroll survey has fallen from roughly 60% in the late 2010s down to its current level of just over 40%, which sees, but there's no sign of political interference based on recent volatility and revisions through political cycles. And that's the point, really. They've always had issues with their revisions. And, it's just a little worse now because of this. But the question is, why did he try and sack? And well, the answer is either he didn't like the number, or is it that he actually said, well, these numbers are so unreliable, I want somebody who can produce me reliable numbers. And I've had for some time a very deep concern about statistics in the US and statistics in Australia, because I believe that some of the Australian statistics are as wobbly as well. And recently the ABS came out and said, well, we're not going to publish some of the yearly analysis of household statistics because we don't believe the surveys. And I'm thinking, well, yeah, I wonder how much we should trust the numbers here as well, because to an extent, two forces are actually in play both in the US and here. One is that actually the structure of the workforce, for example, has changed dramatically, a lot of informal work and those sorts of things. And the other is that the funding of the statistical agencies have been dramatically reduced, which means that they're not able to do as much as they used to. So they're having to cut corners. And for example, the ABS now are publishing the lending statistics on a quarterly basis rather than a monthly basis, which makes them almost useless because they're no longer that relevant. So it seems to me that we've actually got a real issue about the quality of the data on which decisions are being taken. And when Trump, of course, says, well, I want rates to come down, Powell says, well, this is what the data is telling us at the moment. Is that data right?
Yeah, and it was one of the government departments that was targeted by Doge as dropped off a few employees courtesy of airline as well. But yeah, so it's certainly an issue, and I think that's true of a lot of economic statistics, and when you dig into a lot of these tables as well, when they're like, oh, whatever was up from 80.1 to 80.4 this month. And whatever the thing is, and everyone's like, that's fantastic. And then you look at the error range and you're like, well, when we're saying that, we actually thought, when we're saying it's 80.4, we think it's somewhere between 85 and 75 and whatever it is. And you're like, yes, the error bands on these can be pretty wide. And so, you can get way too over focused on a short term, oh, this number was up, that number was down.
Just one other thing, seasonality, of course, because the markets are moving very differently and the employment market as well, maybe some of the traditional way that seasonality is overlaid is also off as well. And I believe that's very true for some of the lending statistics that are season adjusted. A lot of it's actually nonsensical because actually things have dramatically changed, but they've changed relatively recently. And so by definition, statistical agencies who rely on looking back over the last 5 years and say, on average, this happened, it's meaningless.
Yeah. And there's there's lots of those ones that sort of flow through in all sorts of areas that you can sort of look at in terms of what was one of the examples I had in was just changing of demographics and things. So the jobs market was one of them where it's actually you're looking at these long series of job advertisements and saying, well, yeah, but back in the day, a job advertisement was me filling in a form and faxing it off to Fairfax or whatever it is and getting an ad placed in there wherever it is. Whereas nowadays recruiters can go, bam, I've just stuck 20 jobs up all over the place. There's no printing cost and all that type of stuff like that. If I'm a big advertiser, maybe it's actually I can be advertising the same job with slightly different wording in order to attract more people or whatever it is. And so maybe one job ad today is actually not worth one job ad from 20 years ago. It's a different, we're just measuring different things.
Yeah. Absolutely. And a little comment here about currency to basically is part of it's a leading indicator. And look, money supply is booming, right? The money supply in Australia and in the US never been higher. Devaluing the dollar all the time. Another little observation point, which I'll just share at this point, was that this is US data. Despite improvements, consumers still anticipate rising unemployment and elevated risks of personal job losses. This is from the University of Michigan. So again, some of the softer data is also looking a bit wobbly. Now, of course, Powell has in the past tended to dismiss some of these softer data. But my point is, if the harder data is also suspect, then what compass have you got to steer by?
Yeah, that's right. And a lot of that softer data, particularly those consumer confidence ones, when you see the breakdown by political affiliation, it's just crazy. Right. Yeah. It's basically like before Trump was in, the average consumer confidence for Democrats was 60 and for Republicans was 40. And then Trump gets in and it just reverses. And you're just like, well, just a minute, if it's just whoever's in place, nothing else has changed except the person in place. How much can we trust if half the population is going to be upset just because their person's not in, and the other half's going to be delighted, or vice versa? And so, yeah.
Now, just one little thing to sort of talk about as we go through here. Of course, the reason that Trump wants interest rates cut is because he wants more of a sort of a sugar hit in the economy, and also the fact that housing is quite weak at the moment in the US. So there was some recent data that came out, I'll put the slide up here, that shows the estimated number of US home buyers and sellers have actually broken out. So there are more sellers than buyers consistently. Now, when you actually look at the reason for that, some of it's to do with the fact that the average mortgage rate is still relatively high at the moment, and that's linked to those longer term bond rates that we spoke about earlier on. So he's arguing for that, and also, of course, wanting to make a comparison between the rate cuts in the Euro region, because they're down at sort of 2 something now, and the US, and saying why hasn't the US cut? But of course, the US economy is completely structurally different from the Euro economy, not least because of the AI boom. And if you look at the data from the Eurozone, inflation is roughly in band there, and the jobs levels, unemployment levels are still quite a lot higher. So actually, it's hard to compare one with another and say we should be doing the same.
Yeah, and one of those other things going into those the US, certainly the home building side, and that has been quite weak, is that you add on top of those. We've got tariffs on steel, which is a big input into home building. You've got tariffs on copper. You've got tariffs on Canadian lumber. You have there's a large amount of undocumented workers end up in that area, so they've got a rising cost of employment, or just not being able to find workers if you just sort of lost some of your workers. And so it's an area where and the last one I want to add on that as well is you still have the overarching one where there's a lot of people, which is almost the opposite to what you had showing there, but there's a lot of people who had locked in lower 30-year mortgages at whatever it was, 3% lower than what current rates are a few years ago in the pandemic. And for anyone in Australia who's not aware of how the US ones work, you get a fixed mortgage for 30 years. And so if you've locked in at 3% and rates are now 6%, and you're thinking about moving, you're like, well, wherever I move, I'm going to have to get a new mortgage. I can't take this mortgage with me. And so I'm going to have to double the interest rate I'm paying. And so there's a lot more people then, are just going to stay put. And so, I guess where I was getting to with this is there are so many different factors and things that are changing that it's very hard to tell what's going on within that market. And I think this applies to a lot of what Trump's doing. Is that, I'm pretty sure I spoke about it last time when I'm on. Paradoxically, when you've got one thing to worry about, you might go, okay, I've got this problem that there's a pandemic going on, and I might lose my job and all that type of stuff like that. Okay, I'm going to pull back and I'm not going to do this, whatever it was I was going to do. And then when you start adding more things, you're like, this is, one's higher, one's lower. This is, tariffs are on, they're off again. There's people being fired from government departments. Oh, actually, no, we're hiring them all back again. We're going to be cutting all these costs. Actually, no, we're going to be running $3 trillion deficits. There's just like, it's back and forth and back and forth. And people just go, look, I don't know what the hell's going on. One day it's this, one day it's that. You know what? I'm actually just going to keep doing whatever I was doing and wait till I actually until the door hits me in the face. Like, I'm not, because I just don't know what it's going to be. And it's probably quite a reasonable position for people to take, is that, it is possible that I think if it was only tariffs and the tariffs had come out and they're like, there was that first round of tariffs and they're like, this is how high they're going to be. And, regardless of what it does to the economy, that we're sticking with it, we're not backing down. I think if it had just been that, the US economy would have been a lot weaker. People would have been very worried about it, and the whole concern about it, and tariffs coming and it's going to destroy it. And it'd be a little bit self-perpetuating. Whereas I suspect we're a little bit the opposite direction, where people haven't sort of pulled back because they're like, I don't know if they're on or off. They're on today, they're off tomorrow. I'm just going to keep doing whatever I'm doing. And so, the negative effects, I still think they will be negative effects, but I don't think they'll be as big as if it was, the original round. And I think there's potential now for other things to sway it. But it is that as we spoke about earlier, this is a key thing we're watching. Are the negative effects from these tariffs and all this other mayhem that's going on? Is it enough to tip the US economy over into prolonged downturn, or is there enough other stuff going on, including governments, spending money as fast as they can, that's actually going to be enough to keep this thing, from falling over?
Yes, and of course, in the US in particular, the recent big beautiful bill, including some substantial tax cuts and other bits and pieces, is going to have quite a significant impact on the deficit as well as that. But it's all about a bit more spending, and of course,
and company. Oh, sorry.
Yeah. I was going to say I was reading the other day an interesting correlation between government spending, rise in money supply, and company profits.
Yes, that was exactly where I was going to with this.
Yeah.
It's a big picture wise. You've got consumers, governments, corporates. Well, there's an external sector as well, but let's ignore that for the moment. But you've got the three of them, and so when the government's out there spending lots of money, it usually ends up that either the consumers are going to catch that in the form of higher wages and greater share of the economy, or it's going to be business catching it, and the business is way better at catching government spending than consumers are, and we're not sort of looking at what wage growth is coming off, and so it's a pretty good bet that when governments are spending money, corporates are going to be improving their profits with it.
And just on the money supply issue, I've got this data for Australia that shows that if you look back from 1970 onwards, you can see there that the Oz M3 money, which is the top one, and the Australian property market is pretty much traveling in the same direction, whereas wages growth is nowhere near. And there you go. There's your problem, right? And that's really the issue, that the money supply and the growth of company profits can go in one direction, but if the wages growth is going in a different direction, then long term we have a problem, because what it means effectively is that households are getting crushed more and more by the gap. And that for me is part of the conundrum we've got, because of course everybody looks at some of this, but not all of this. And the Australian situation is explained by that chart.
Yeah, and that's in a big picture sense as well. This is an inequality, saying we've got all this money, extra money in the economy, and it's out there being spent, but it's not ending up in terms of higher wages, which sort of is a bit of an equalizer in terms of spreading that money out. It's ending up in higher asset prices, and the issue then is the asset prices go up. One group of people gets really rich, the wage earners don't, and that group of people that gets really rich then goes, I've got nothing else to do with, I'm getting more and more money coming in. I've got nothing else to do with it, so I'll just go out and buy more assets with it, and more stocks and more bonds and more equities. And so it's a question about, is some of the excess valuations we see in markets, how much of that is down to greater money supply and more inequality. And so it's sort of a bit of just a game of saying, well, if we took all the money and gave it to everyone, maybe markets would come down a lot and house prices would come down a lot, but everyone would be a lot more equal, or are we just going to keep perpetuating? And at the moment, when I first started Nucleus sort of 8-9 years ago, this was one of the big themes. One of the big themes we had was this increasing inequality, and one of the other ones we had was the falling tax rates and
corporate tax rates
and the sort of corporate tax rates, yes, but also personal tax rates as well. But
well, they've been going up recently. If you look at the proportion of income now going to pay tax in Australia, it's a lot higher.
Sorry, no, you're right. It's probably more in terms of no, you're right. It's corporate tax rates, and so the idea is, I've been talking about this. When we actually genuinely see that start to reverse, that's when you might have, you might start to see some issues. And this big beautiful bill is not reversing it at all.
No, it's not. It's
like,
not.
So I mean, what it was 15 years, 17 years ago now, when, in the middle of we had this whole Occupy Wall Street movement and this whole thought that, actually, this big rise in inequality we'd seen over the decade before was going to start to dissipate, and you're going to go back to a more equal. And that sort of died pretty quickly, and things are way worse now than what they were at that point. And,
Absolutely.
Yep.
Yeah, and it's just to build that out just a little bit more. This was actually an article I saw very recently. Home prices have skyrocketed to a record close of 14 times average annual wage, compared with about just 3 times 100 years ago. This is from work that AMP chief economist Shane Oliver has been doing. House prices compared to both wages and income are now around record levels. And whilst there was a bit of a dip last year, it's now bounced back again. It's just getting worse, and of course refer back to the demographic survey too. So you can see here structurally we have an issue insofar that the flows, which are magnified, by the way, by debt. So the debt bomb is continuing to rise. A lot of that debt, of course, is going to corporate land. It's also going to consumer land as well, and government land. So you've got this magnifying effect. You've got the banks able
to add to that magnifying effect as we put in 5%. Loans down for new home buyers.
Yes, exactly right. I was going to say, with all the incentives for first-time buyers to get in, et cetera, et cetera. Plus, of course, the fact that the multiplier effect then means that banks can lend more because prices are higher. And, the old marginal theory of the way that money works isn't really very true. It's driven very much by the bank's ability to create more money as they lend more. And that then creates more liquidity. So you can see that that's all part of this money supply growth. So it's the governments pumping the money supply, the banks continuing to pump it. That money supply flows then into greater corporate profits. So that sector's all right. But at the end of the day, ordinary people seem to me to being left out in the cold here. And there's no real intent to change it.
No, that's right. There's, I guess it'd be interesting. The political pendulum does swing from side to side, and you are starting to see some signs in the US, I think. I forgot the name of the mayor in New York, or the Democratic nomination for the mayor in New York, does look to be very much on the side of let's try and even this out. But long
way to
see
go.
Whether that's just a flash in the pan or whether there's a genuine move back in the other direction. I think.
I just wanted to throw just one other little thought in as we sort of mull around financial stability and what's happening. Central banks, of course, are actually grabbing gold. This is actually from the World Gold Council, and you can see there that in 2025, Q2, again quite strong. Quite interesting just to see how it's tracking. This, of course, is only half the year. But you can see over from 2022 onwards, central banks have been grabbing gold, which suggests that some players, maybe in Asia, are actually thinking that the current system isn't necessarily that stable. So I think that's another fascinating insight too.
Yeah, I'd put down 2 parts to that. One part is, a real push for gold for me was Ukraine war broke out. Russia had its reserves seized. And then, so if you're a country, who's not in the greatest of graces with the US, and not, you didn't even need to be an enemy. You just needed to be somebody who's like, well, we're a small country somewhere that we're thinking about. We really don't like our neighbors, and we might attack them one day. How much do I want in US dollars just in case the US decides to seize all my money? If I do that, and how much? So maybe I need to be putting more money into gold. And so I do think that was a big push for gold a couple of years ago. And then I do think that sort of hasn't been lessened at all by Trump now, where it's like tariff here, tariff there. Everything's you put a political person, Brazil's, even though you do have a deficit, you put a political person who I like in jail, and so you're getting a 50% deficit, a 50% tariff. I think there's a lot more incentive for countries to say, well, the US is a lot more erratic than it used to be. Maybe I need more money in gold rather than less money in gold. So yeah, I would think that central bank is just risk, even if it was, even if they didn't think it was going up, as just a risk mitigation strategy. And I do think that's whenever you're thinking about gold, it's partly an anti-dollar story, but the real key thing to work out is all the buying comes from either central banks, or not all the buying, but almost all the buying comes from central banks or investors. And so it's taking a bet on a central bank's buyers or sellers. That's one part of it, and then other investors, buyers or sellers, because it's the greater fool theory. If I think somebody else is going to buy it, I need to get in there first before they do, and push it up. So.
And just on that, here's the current trend on gold prices. So it's up again, 3409, just moved as I spoke there. And you can see that it reached a peak of close to 35 back in April. And it's going up and down, up and down, up and down, but hasn't gone above that. But it is interesting that, the gold story does seem to be very much part of the signal. Now, some people would say it's a safe haven. Others would say, well, actually, you don't get a return on gold unless you hold it and let the appreciation rise. But I guess as a portfolio view, you'd probably have some gold in the portfolio as part of the structure of it.
Yeah. So we hold some stocks, some gold stocks, but also we do have the tilts. People can add, 4 or 5 different types. You can either get gold miners, a basket of gold miners. You can get gold hedged to Aussie dollars, gold unhedged. A few other things you can sort of put in. So as you're choosing a portfolio with us, you get this core portfolio. It's sort of the nucleus of it, which is, say, the largest stocks in the world, or a mixture of Australia and bonds and cash, Australian stocks, bonds, cash, all that type of stuff. And then within that, you then take things out. I don't want to have anything to do with climate change, or I don't want to have anything to do with, say, Aussie banks. You can sort of pull those out, and then you can add things around. And one of those is gold. So, but in terms of gold specifically, I just spoke about that. Really what I was talking about there before was, in terms of being an anti-dollar, part of that is the idea, well, if the US is going to debase its currency, so what do we mean by that? Well, they're going to issue as much debt as possible, and they're going to have a central bank that's going to be monetizing it and or dropping interest rates, and so inflation is going to be higher. Then that's a good thing for gold. It's an anti-US dollar, and so if you think the US is going to be debasing its own currency, then gold is a good place to hide. So that's on one front, and then on the other side, the political instability. If you think things are going to get less or a lot more stable, and countries going to be a lot closer, and if we're going to start trusting the US again, then you might be more concerned about the gold price. Whereas if you thought Trump's going to make things worse, and there might be further stuff going on with Russia and other countries, then it's a reason to see why other people will be buying it. And again, as you said, there's no yield to it. It's really just do I think other people are going to do this, and do I jump in front before other people do? Whereas I'm personally much more comfortable holding stocks, and where I can actually see, yes, look, people buy these things. People buy their goods and they've got them, and they give me a yield every year, and they go up in value, and over the long term, if I've got a diversified basket of them, it's actually very stable in terms of the earnings you can get out of them, as opposed to gold, which is like, no, it's not earning anything. It's actually costing you something in order to hold it. And then, but I'm relying on the fact that maybe somebody else wants it more, so other people want it more.
So I guess it does take you to the very interesting question when you think about investing, and we're talking here investing rather than speculating, right? Investing means trying to build a wealth future for you, so that as you move into retirement, you've actually got sufficient income to be able to, cover the costs that you need to cover to be able to actually live well. And there's a lot of analysis being done around the place about the different amounts that would represent. And people are quite surprised often as to how much you actually are going to need to be able to actually survive. On the other hand, with the upping of the amount that people are now paying into superannuation, maybe the news is a little bit different now.
Yeah. So I take this in two sort of parts. One is, keep in mind, Australia has, we have a pension. So it's not a great amount of money, but, in contribution with your, even if you have a lower balance, it can end up giving you, retirement that's may not be the entire retirement you want, but it's not, you're not going to be on the street. You sort of that type of, it's not, you do have a safety net there. So I'll talk about some of these numbers. What I'm going to talk about is what I call an infinite portfolio. So basically, you've got a portfolio of stocks and bonds, and you can just live off the dividends that are coming off it, or the interest that's coming off it, and the portfolio will go up. You're not jumping into the capital at all. Now, in the best sense, and I've got some figures up there from the AFSA, which sort of basically looks and says, well, if you own your own home, and what do you need for a comfortable retirement? And this, keep in mind, this is within super, and because super is tax free. So once you're into pension mode, so if you've got all your money sitting in super, and you need 52,000 as a single person or 73,000 as a couple to be living what they call a comfortable lifestyle. So you get to travel a bit, you get to eat out, you get to go to restaurants and all that type of stuff like that.
Just to be clear, Damien, that this is at current values, right? So obviously,
yes,
over time, that would have to go up to track inflation.
Yes, that's right.
Yeah,
that's right. So what I'm talking about is saying if I put into how much would I need to stick into a portfolio where I'm going to get some growth out of it, and then based on historical returns and all that type of stuff like that, how much would I need? And all these numbers are in millions. So my gold standard is if you can get inflation-linked bonds. You've got $3.5 million in inflation-linked bonds or $4.9 million in inflation-linked bonds. And what that means is these are things, they're from the government. You basically buy them and you get 1.5% return, plus you get whatever the inflation rate is. So you're always going, the amount you're getting is going up at inflation every year as well. So so that's sort of like unless the Australian government defaults on all its debts, I'm fine. That's your most amount of money. Down the bottom is probably what I'd call more typical. This is a 60-40 portfolio. And so as a single, you need about 1.7 million. As a couple, you need about 2.4. And keep in mind, again, this is not dipping into savings at all. This is basically saying I've got my principal. My principal is growing with inflation. I've got my dividends. My dividends are growing with inflation, and I'm managing to keep going. So now that seems like a lot, but if you took somebody on, say, what's that equivalent to? Look, if you had a 22-year-old rolling out of university today, earning about 90,000 and getting like a 3% pay rise every year, that would give you that amount as a single, and less than that if you're in a couple. So there's I guess the thing I'm trying to push back to people is there's two parts to it. One is now super's up to 12%. It's a lot of money. Like it's a lot higher than what you see in most other countries. And so as long as you're putting that away, that's going to get you to those levels without doing too much else. That's one part of it. And secondly is the importance of all this is being within super rather than outside of super. First of all, you're getting much lower tax rates as you're earning the money. So you're only paying 15% on stuff rather than 30 or 45% or 47% on your earnings. And then secondly is that in retirement, it's tax free. Whereas, that you're earning $50,000 and that you've got that money sitting outside of super. Well, now I'm getting taxed, whatever it is, 20% of it or something like that, in terms of what you're ending up with. So the importance of getting this stuff into super, and it isn't something you should be thinking, oh, I'll just wait to the last minute and then shove it all in. But and I guess part of this process I was going through was saying, well, for people who are concerned about interest rates falling, where do you start to think about, I want a retirement. I want to make sure that I'm not sort of sitting in 5 years' time with interest rates back at 1 or 2% and just not being able to afford what I wanted to. And that's a part about saying, well, a diversified portfolio, we like to try and lean in and out of the cycles a little bit, but that's where you sort of try and build up more and more bonds the older you get. But the idea that you're taking risk of when you're young and sort of building up as you get older.
And just one of the quick observations, of course, some of those inflation-adjusted bonds, the measure of inflation that they use on the bonds ain't actually very good relative to the real inflation rate, right?
Yeah, that's right. But having said that, it's interesting in a way. Some of these are everyone's got their own inflation rate, and they do inflation rates for if you're a retiree, what's your inflation rate? If you're a young person, what's your inflation rate? And they can be very different. And the questions from some of those sort of arise in terms of saying one of the biggest components of a lot of these is your housing cost. And so the question is, if you've got your housing, you've got housing in your, like this is assuming that you've already owned your own house. And so if you sort of take that out of the equation, so to speak, then you're looking at sort of probably quite a different basket of things you might want to spend money on.
But there's an interesting challenge. And in fact, Cameron Murray's been on about this quite recently again, because he's been talking about this for some time. You know, a lot of people have great difficulty now in getting into the housing market and stay in the rental sector, which means that when they come into retirement, they've still got to find somewhere to live, which means they've got this additional chunk of cost relating to rent. And you know, what you're doing is sucking away people's ability to be able to borrow as much when they're younger, because they've got to put more into superannuation. So there's this a significant trade-off between now and the future, which is being taken away from people because the government's saying, no, it's 15% now, right? So it's an interesting conundrum.
Yeah, that's right. And as part of that, though, there is this there's an overall cost benefit you do as well, in terms of saying, okay, well, having a mortgage is expensive, and certainly if you're thinking about moving, buying a place and moving, 5 years later somewhere else, the amount of money you're paying in stamp duty can really sort of smash the economics of it. And so there is this idea that, well, okay, what do I need sitting within this super if I don't have a house, and if you're sort of looking at that saying, well, if I've got $1 million extra sitting there, how much is that going to make? Is that going to be enough to live in the place I want to live in? And I've got that invested in a market where, whether it's housing itself and you're doing the sort of rent vesting, or you've got it in other markets, where in, say, equity markets, where you've got that growth as well and that protection from inflation, is that that's a genuine problem. The big thing for people who are looking at that type of scenario, though, is I think a lot of people go, oh, look, I can pay $5,000 a month on a mortgage, or I can have $3,000 a month and I can rent the same place. And they go, oh, isn't that fantastic? I've just saved myself $2,000. Now I can have another holiday every year and do whatever this, and buy a bigger TV and things like that. He's actually saying, well, no, if you're taking that view that, look, I'm going to go down that rental path, then you need to be saying, well, I'm just going to pocket that difference and put that into investments where that's going to grow as well, and you can get that the benefit from that. But yeah, you do miss out on the leverage part of it. There's certainly you need to do that. Sorry, and the other thing I was going to say on that front as well is the way the pensions are calculated does disadvantage people who are homeowners as well. And so if you're sort of, especially if you're on the lower end of it, for a lot of people, it is probably worth thinking about. If you had a choice between saying, I'm going to rent and then I'm going to try and get my money to last and use the pension and use that as a function to get me over that hurdle and manage to pay this, because of how sort of inherently unfair the calculations are for people who are renting for, say, pensions versus owning, you're probably better off often putting that money into property, even if you didn't want to buy it and you think it's expensive and all that sort of stuff, just because if you're close to that pension phase, close to getting the pension, you're far better off. You're much more secure in terms of that, being able to get a full pension and own your house, than not be able to get a pension and trying to manage the small amount they let you have.
And that, of course, is why getting financial advice, and good financial advice, that is really, really important when you're thinking about this stuff. Because unfortunately, I see so many people who actually didn't think about it until too late, or worse, they sort of got something off the internet and thought that'll be fine, and then realized they've actually dug a hole for themselves. So getting good financial advice is critical.
And the problem with a lot of this is, financial advice can be expensive. We sort of do some general advice for people to sort of help you down the right path. But we don't sort of, if you go to a financial planner specifically, I think that the economics for a lot of people is, look, you might spend $3,000-$5,000, say, to get a financial plan done up. And for people who are going into retirement with lots of assets and different things like that, they can look at it and go, yeah, I might spend that money, but actually, you know what? I can see where I'm going to get back 10, 20 grand in tax savings, in pretty quick order. And so it sort of makes sense for that. But the thing is, the people I'm talking about who are like, will I be able to get the pension? Won't I be able to get the pension? Scrape by. They're not the people who have an extra $5,000 lying around to say, oh yeah, no worries, I'll just throw that on into a financial planner. And because you don't have the same assets and the same opportunities, the tax savings might not be there for you either. And so, it's tough in terms of that. And that's that whole, as Cameron and I spoke about, the same thing with super. People who have low balances in super or low income earners, are effectively negatively penalised in terms of paying tax that they might not have otherwise had to pay. Whereas the high, really super is fantastic for high earners. They get these great tax benefits, and you get to bundle everything in, and you get these, millions of dollars sitting in super that's sort of tax free, and in retirement, and it's the, it's not helping the people who are close to the edge as much.
No, and I believe that there is a great chunk of the population that actually don't have the financial foundations to be able to do, that top end planning, but actually are very much at risk given the high inflation rates, given the fact that the income growth is not there, given the fact that many of them are renting. And I don't think they get enough coverage in the financial press in particular, because, if you read most of the articles in the financial press, it's all sort of tilted to that top end group.
Yes, yeah, absolutely. So, and actually, that's one of the things we are doing within ours is for the first home buyers. And so, certainly, for anyone who's, particularly if you've got, whether it's yourself or if you've got kids or grandkids who are sort of in this position, is saying you can use the tax rate in your super to save money. So this is the first home buyer super scheme is not about using your super to buy a house. It's about using the tax rate in your super. And the tax rate in your super is lower, almost definitely. I think if you're managing to save for a house, it's almost definitely lower. So, as an example, somebody who's on, $100,000, 30-something% tax rate, you want to save $1,000 a month to buy yourself a house. If you're saving $1,000, so $1,000 pre-tax money, then if you're not doing it in your super, you start with $1,000, you end up with $700, you stick that in the bank. Now you're getting taxed at 30% on that money. If you do it within super, you start with $1,000, you get $850 sitting in your super, ready to use that to buy a house. So on day one, you're getting a 20% better outcome. And that's just if you're on that sort of 30% tax rate, and it's better the higher the tax rate you're on. And you can do that for both you and your partner. So there's limits to it, but very much encourage anyone who's thinking about buying a house. There are downsides to it. If you don't buy a house, you can't then go and use it to go on a world trip or buy yourself a new car. You need to be certain you're going to use this for a house, but it's a very tax efficient way of putting that money away.
Yeah, and certainly from my experience, people have not necessarily engaged with some of those schemes that do make a very significant. Remember that it's accumulating over time. So thanks to the beautiful effect of compounding, money on money on money, it makes a big difference to the outcome.
Yeah, and that's one thing I will come back to as well. You spoke a little bit about what do you do right now, and the problem I run into this issue all the time with people in terms of saying, people who are invested in the market and have been invested for a while are sort of happy with the idea that, okay, when markets get a bit expensive, we pull back a bit. When they fall, and hold a bit more cash, and when they fall, then we then flip you back into stocks and sort of push it up. And people can be comfortable with that. And so, say somebody who's got $300,000 sitting with us, in that position is they're sort of they feel comfortable that they're on the ride. Yes, we're trying to scale back and make things, make the drops not as much and not as much volatility. But it's a person who's sitting on the sideline, and I've got a number of these who have been with me for years going, okay, I've got 300 grand. I want to invest in the market, but I'm worried I'm going to invest at the top. And so I don't want to dump it all in now just in case the market falls tomorrow. And it's the problem that you have a continual, you'll never, I can tell you right now, there's never going to be a day where you're going to wake up and everyone's going to be telling you, today's the day, you've got to get out and buy the market and shake you and drag your money, drag you down and get you into the market. And so I do think there's that idea that you just got to start somewhere, and that gradual investment over a period of time, that's what really builds wealth. and that continual, yes, I'm reinvesting, I'm taking money out of my salary and putting that in every week or every month or whatever you get paid, and that continual reinvestment, that's what builds that compounding wealth over time. And so, quite frequently what I say to people is, look, 18 months, you think things are going to fall apart because Trump's going to ruin the world in the next 6 months. Okay, well, let's use an 18-month time frame. Let's stick 10% of your money in now, and 10% every 2 months. And in 18 months' time, you'll be fully invested. And if he hasn't ruined the world, if he ruins the world in the next 6 months, you know what? You can dump the rest in, and then you'll get your cheaper price for that. But if he doesn't ruin the world in the next 6 months, then in 18 months' time, you'll be fully invested. And so it's that idea that there's got to be some way, and whether 18 months is the right time frame, or 5 years, or 6 months, or whatever it is right for whoever. But there's this idea that, look, if you're sitting on the sidelines waiting for the perfect moment, you're never going to see it. Pick an amount and just sort of gradually get that moving.
Well, there's 2 points there. The first is the idea of market averaging. So basically, you drip stuff in over time, and wherever the market is, then it's going to actually average it out. The second is, of course, markets long-term go up and to the right. Why? Because, of course, the amount of debt in the world goes up, as we described. The liquidity goes up, as we described. So markets tend over inflation. So markets tend over time to go up to the right. So time in market, in other words, time invested, is really, really critical too.
Yeah. So I mean, if you did a quantitative study and said, when is the right, let's say I've got a big bucket of money, when's the right time to put it in? The answer is actually today, or tomorrow, whatever, whenever you can trade. Is the statistical answer, because they go up over time. Now, obviously, that's not true of every time point. There's, if it was you bought just before the 87 crash, or just before the tech boom all fell apart and all that type of stuff like that. Like, there's definitely times where risk are elevated, but it is what I've spoken about, the strategy there is partly is a risk mitigation and a regret minimization sort of tool. That's saying, yes, you know what, if I happen to start the day before the whole thing comes falling apart, I'll put down 10%. Okay, I might be losing 3 of it, but that's not going to kill me in the long term. If you have a 30% fall in the markets and I've put in 10%, I've just lost 3. But now I've got an opportunity. The markets are down. Now I've got an opportunity to keep putting more money in. And you can always accelerate it, and you can always pause if you don't feel like doing it. But I think for me, it's getting the default position being away. The default position should be do something with it, not the default position is, you know what, I'll just leave it in the bank until I feel really good about everything. Because that's, it's either not going to happen, or the time it's going to happen is when is just before the whole thing falls apart, because it's like, markets have been up, 20% per annum every year for the last 5 years. And it's like, oh, that sounds fantastic. Let me pile in just before it all sort of tips apart.
And of course, the other point is there that markets go up and markets go down. If you are just in the market, it doesn't matter too much, because the only point where it becomes important is if you need to liquidate and get out for any reason. But that means that if you're coming to a critical decision point, for example, retirement, in the few years before retirement, it becomes ever more important to do that piece of financial planning and to think it through, because the decisions that you take around that critical event actually will determine your financial future much more significantly than if you've got another 20 or 30 years to run.
Yeah, absolutely. Which is why for most clients, as you get closer to retirement, we just gradually increase the amount of bonds that we have for those clients.
Jolly good. Now, one of the other things we should share with people is your recent results, Damien, because they were pretty positive, weren't
they? Yeah. So AFR published the top 10 super funds, and we were number 2. We went. So this is a top 10 growth funds over with over $1 billion. Now we didn't have over $1 billion in that fund. So we went on their table. But in terms of performance, we've got our performance gets measured by independent third parties. And we came in number 2 on that for the growth market for the 12 months through to 30 June. So yes, very great result. Thanks to all the team behind to put that together. We're sort of proud of what we did. The idea was very much that we trying to keep as much risk on those as we dared, but then pull back when we thought things were looking too toppy.
Sorry, the dogs are making a barking noise. The reason they're barking is because somebody's fired at motorbike just over the road and the dogs react. Yeah. So I guess then the question, Damien, is in the current environment, have you made any changes to your weightings in your portfolio, or are you pretty much sitting pat now?
In terms of the overall equity weightings, not really. We've sort of been sitting with a reasonable amount of cash. We have been sort of really trying to dig into some of the stocks, and we just went through a meeting today, actually, of a number of stocks, which sort of high quality stocks we really like, been sitting on our list of things we wanted to buy forever, but they just haven't been cheap enough. And a mixture of tariffs and what Trump's saying about particular countries. So a lot of these are ones sort of outside the US. But yeah, there's particularly there's a number of sectors that we've sort of targeted in terms of saying, we like some of the companies when we think they've got high quality earnings. We think they're up against it at the moment in terms of whether it's tariffs or if it's like we've got a lot of companies that do that make some of the green energy. Things like wind turbines and service players to that market, just because the prices are beaten down so far that they're actually pretty cheap relative to their history. And if you take the view that Trump won't be president forever, and at some point these things will be worth a lot more than what they are, and they're growing at reasonable rates. And what we're really trying to find at the moment is trying to improve the quality of the portfolio. Now, that sounds like it's like, oh, well, shouldn't you always be trying to do that? And the answer is no, not really, because what happens is the lower quality stocks are the ones, when you go through sort of like economic booms, they're the ones that tend to rise the most. And because they're just real, they might only be making a 2% margin. And so their margin goes from 2% to 3%. And all of a sudden their actual profits are up by 50%. And so those types of companies, benefit the most when you're going through those boom times. Value stocks sort of seem to sit in a similar category. A lot of commodity producers and things like that sort of sit in these very low margin stocks. An extra tariff can all of a sudden send them into a loss or things like that. And so they're the stocks we're trying to avoid, is sort of the value stocks and the lower quality stocks. And really what we're trying to target is the higher quality ones where we think that you can get much larger margins, and so you get a lot more room to play if you do get a tariff on you. But also that a lot of these stocks are the stocks, especially if they've got good returns, the types of stocks you grab, you buy, you stick them, and you sort of not completely forget about them. But the idea is that if I can buy these really high quality stocks at a reasonable price, then it's probably going to sit in my portfolio for years or decades, as opposed to when we buy stocks that are very cheap, but sort of an average quality, but situationally cheap or growing their earnings particularly strongly, is that it stops being cheap or the earnings growth starts to peter out. Okay, we're out of that stock and into something else. And then the last type of stocks, big picture stocks, is the growth stocks, and we're really not in those ones much at all as well. If Trump's sort of policies come, like if he throws more fuel on the fire and it lights up and there's this big economic boom, then there's some of these growth stocks are going to do the best. But by the flip side, if he pushes one tariff too far, they're the ones that are going to do the worst as well. And so it's just such a broad spread. So for us, it's all about saying, companies with lower amounts of debt, bigger margins, can handle tariffs, and especially ones where we're looking and going, well, actually we might like a company, and it's particularly beaten down because Trump's targeting the country it comes from, or Trump's targeting the sector it's in, and we can see that we don't think their long-term prospects are going to be forever bad.
Excellent. Well, before we get to the end of the show, one other quick questions. The banks were downed recently. CBA, of course, had been up very much higher than a lot of people could explain logically. They've come back a little bit. What's your take on the Aussie banks at the moment?
Expensive. Well, and Commonwealth Bank in particular, it's not the most expensive bank in the world. It hasn't got too many peers. So, look, I get the whole, okay, if interest rates are falling in Australia and house prices are going up, then they really don't have a lot to worry about. And they're obviously very tight with the regulators and governments, and so they're going to keep charging lots of money and making good profits. It's really a question about growth, though. And at some point the cycle will turn. I don't think it's And I don't think they're in that that much of an issue at the moment, but at some point they could be. And you certainly don't want to be anywhere near the banks if there's any sort of whiff of corporate failures and or house prices falling and things like that at current levels. They're pricing in a level of perfection that I just don't think is available, and mostly Commonwealth Bank. To a lesser extent, the other banks, but Commonwealth Bank in particular is just priced at levels which, can't be explained rationally.
Exactly. And I still am amazed at the number of people who keep saying, we don't understand. But of course, index funds have to pile in when the bank is going up because it's a greater share of the overall index.
Yeah, if you're buying Australia, if you're an international investor and buying Australia, then by default you're getting 12 or 13% of what you're investing in is Commonwealth Bank. Yeah.
Well, as we come to the end of the show, Damon, thoughts for the next couple of months over the summer in the US? It'll be all quiet, of course, nothing much going on.
That's
right. September and October tend to be down months in terms of market performance, but then probably run up towards the end of the year.
Yeah, maybe. I mean, I think certainly assuming that Trump is going to, say different things and they're going to send the markets higher and lower, I think is a pretty safe bet. I do think there's a number of different issues you need to be watching. The foremost is earnings, company earnings. So that's the one we're really sort of focused on. Is that they're holding up way better than you would have thought. Maybe they'll all suddenly come a cropper, but and if they do, that's where you're really going to see markets start to fall apart. So that's one side of it. The broader economy in the US. I think if you saw a reasonable amount of weakness in that economy, but you didn't see much effect on earnings, I think the markets will hold up under that because you'll see lower interest rates sort of helping valuations and earnings still, as long as they're not falling away. So that's really where we're focused at the moment. And as I spoke about, the earnings are still pretty strong. They're not double digit growth, but they're certainly 5 to 8% growth, and that's a pretty good return for stocks.
Well, Damon, I really appreciate your time today. It's been really interesting, and I think we've highlighted some of the dilemmas that everybody faces, but also some suggestions as to how to tackle some of those dilemmas as we wobble through the summer and see where we go next. In terms of the poll, it's quite interesting. So I asked at the end of 2025, markets will be higher than now, 44%. Markets will be lower than now, 23%. Markets will be the same as now, 2%, and no idea where markets will be, 31%. So that's where the results were. So it's all over the board.
I feel like 2% seems to be a bit low it depends on what your range is, I guess. I suppose if you said plus or minus 3 or 4% from where we are today, I feel like that's the odds. The odds are a lot better that that's where it is. But yeah, look, it's. I think trying to. That chart I showed before about the momentum players, they're the ones who are trying to pick the next trend in terms of that. And I think they've had one of the worst years ever. I think trying to do that and trying to front run whatever you think Trump's doing is going to be difficult. But I do think there's elements in terms of saying when you see stuff beaten down, okay, let's flip into that sector. When something goes running ahead because there's definitely a few things like your oil and gas or whatever. Yes, we're going to be the greatest thing ever for oil and gas. Is like, well, when I see stocks jump up, I'll clear out of that and move into something else because, that's a very typical one of saying, well, just because lots of people are going to be doing drilling doesn't necessarily mean the companies in that sector are going to be doing well. And so there's lots of examples of that.
Oil price is down again, of course, because OPEC decided to release some more into the market. So interesting. Damien, thank you so much. Tariffs, yes, Cookie, we discussed tariffs earlier on. You missed that. I think you joined us a bit later. And Jason, thank you so much for the super chat. We really appreciate that. Really helps to cover the cost of the show. So thank you, Damien. Thank you, Jason. And Damien, thank you very much for spending time with us this evening. Really appreciate that too. Hopefully get you back on next month. Hopefully the first Tuesday of the month, as always. So I look forward to that.
Sounds good.
Great. And I'm going to take you offline and close the show. Thank you very much.
Thanks a lot.
There you go. Well, I hope you found that interesting and informative. I certainly did. And I think it'll be an interesting couple of months to watch. So it'll be interesting to get Damien back on next month. Next week, I'll be going through my latest surveys and financial stress and all of the issues around that. So join me for that then. There'll be released shows, of course, every day of the week. And I think this Friday I've got Tarek teed up for an interview. So I look forward to that. And that should be coming out on Friday as well. So thank you very much for spending some time with us this evening. Here are the dogs, now back quietly as though they've never barked in their lives, but you heard that they did. The chap over the road was revving up his motorbike to see whether it was working, and they really wanted to respond to that. The reason for that is they're actually brought up on farms, and every time they hear motorbikes, they want to go and sit on the crossbars. It's hilarious. So there you go. That's it. Thank you very much. Take care. Have a good week, and we will see you next time. And please like and share. And we'll look forward to seeing you next week. This is Martin North from Digital Finance Elite signing off. Cheerio. Take care. Bye-bye.